Hey, everybody, and welcome back to another episode. Today, I've got Kenneth Gee on the show. Kenneth is the founder and managing partner of KRI Partners in the KRI group of companies. He's got more than 24 years. That's like a quarter century, man, of significant real estate, banking, and private equity transactions. Throughout his career, he's been involved in transactions valued at more than $2 billion, much of which has included the acquisition, management, and financing of various multifamily real estate projects. This guy is an underwriting guru. I'm super excited to jump into that with him today. Kenneth, welcome to the show.
Thanks so much for having me.
Yeah, dude, this is an absolute pleasure. We're kind of bouncing some ideas back and forth and getting to know each other before the call. And I'm excited to go under your underwriting experience because there's two big things that I feel like people go wrong in real estate, and they try to complicate it, but it really boils down to two things: the operator or sponsor and the deal. And it doesn't matter how great of a sponsor operator you have. If you have a crappy deal, there's nothing you can do about it. I mean, you just can't turn lead into gold. At least I haven't figured out how they do. And you can have a really, really good deal and a bad operator and sponsor, or just destroy it and turn it into a bad deal. So I want to talk about that today, doing some of the underwriting on, how you can prevent a loss of your capital, especially if you're an investor when you're looking at these multifamily deals. But before we jump into that, for those that don't know you, tell us a little bit about your background and how you got here.
Yeah, happy to do that. I'll give you the Cliff Notes version. So I grew up in Toledo, Ohio. Nobody knows where that is until you think about MASH. If you think about that sitcom way back when, Max Klinger always talked about Toledo and Tony Packo's hot dog. But anyway, I did actually know Tony Packo, by the way. So I grew up in Toledo, got my undergrad from University of Toledo in finance, went to Cleveland. Worked as a commercial lender at a bank for 5 years while pursuing my master's degree at Case Western Reserve. That's a small private school. Then I left the bank and went to work for Deloitte and spent 7 years there as a CPA, doing all kinds of stuff, some compliance, lots of merger and acquisition work, lots of work with private equity firms and tax planning, all the really, really cool, fun stuff. But what happened there, so now rewind the clock 24, 25 years, my kids were very, very young. My daughter was just born, and I would do her 3 a.m. feeding, right? Because I was working at Deloitte like a dog, 70, 80 hours a week, and the only time I got to spend with my daughter was at 3 a.m. Now, I love that time because everybody else is sleeping. It's just her and I. It's quiet. It's really good father-daughter bonding time. If any of you are a father or anybody out there who's a father and has a daughter, you know exactly what I mean. I mean, it's a really cool time. Problem was, after a while, I started realizing, wait a minute, what's wrong with this picture? It's 3 a.m. and this is my quality time with my daughter. I'm like, man, this isn't cool. And it just kept bothering me. I said, wait a minute, I did everything I was supposed to do, right? I went to school, got good grades, got a good job, doing everything I was supposed to do. And now here I am. I've supposedly arrived, only to realize that I don't even have time for my family and to spend time with my kids. And I just said, this is not cool. I got to fix this. That's what got me headed towards real estate. I will tell you that it took me about 1.5 years because back then there were no cool podcasts like this. There were no courses. There was nothing. So I really learned the hard way. Took me forever, but I was able to find 3 deals and over, 3 small deals in Cleveland, like 20, 25, 28 units, something like that. And over a 3-year period, I sold those 3 deals at the end of the 3-year period and made $500,000. And I was like, whoa, time out. What just happened here? Like, I made $500,000 on the side. That was more money than I'd made up to that point at Deloitte the whole time I was there. I'm like,
light bulb.
Wait a minute.
It's going off.
I said, man, I thought I had a plan when I got frustrated that night with my daughter. I put the plan into place, and now I just prove it worked. So guess what? From that point on, we have not turned back. And we ended up leaving Deloitte in 2001 and have been on the real estate track ever since then.
Man, and what do you invest in?
Multifamily. All value add multifamily. Yep.
Okay, so value add multifamily. So you had this amazing career, and I feel like that's the unfortunate trigger point for a lot of people is growing up, we get sold this idea of go and get a really good job and, make a lot of money or climb the corporate ladder, become the CEO or the CFO or whatever. And, make a certain amount of money. And then a lot of people live half their life getting there, and they get there and realize, holy crap, I've been chasing the wrong thing.
Yeah.
And it sounds like that was a big point for you. And for you, it was your daughter and the amount of time that you were getting to spend with her. And it just wasn't, you were like, oh, wait a minute. Why should I settle for this? And then
Yeah.
you stumbled upon this other vehicle that gave you this flexibility and this freedom. So tell us a little bit about that. Did you get started in multifamily? Was that the first thing,
Yeah.
or was there like a kind of a ramp up stage? Because I know you had a pretty diverse background with working with a lot of big firms that were in real estate, and that might be where you kind of had your secret sauce to get in.
Yeah. Actually, believe it or not, though, my experience at Deloitte had very little real estate associated with it. It was mostly M&A, private equity firm. I mean,
Okay.
they're buying and selling companies. So we buy and sell real estate. It's a similar concept, and it's valued pretty much the same. But what happened was, as I continued down this path at Deloitte, right? I realized I need to create passive income that is going to equal my earned income. That is my ultimate goal. That's where I'm really trying to go with this, right?
Yeah.
So in the beginning, I looked at, all right, wait a minute. Can I do this with single 1-to-4s? Like, man, I don't know. I don't know how to fix anything. Like, I couldn't fix a leaky pipe to save my life.
Yeah.
But I'm at Deloitte, so I can't go there and fix it myself, even if I knew how. So I said, I looked at the really big stuff. I'm like, man, my Rolodex sucks. I don't have enough people in my Rolodex to go raise money or get partners that have, enough cash to do these deals, because I was, very early in my life. So there's a reason I'm telling you the story this way. This landed me on small apartment buildings. The first deal I did was 28 units. And the reason that size made sense to me, even though it's really small, I was able to hire a part-time lady to be at the property, give her an apartment and some extra money. And she took care of the leasing. She took care of coordinating maintenance. And all of a sudden I could operate it, quote unquote, like a business.
Yeah.
That's why I did that size. I can't do 1-to-4s that way. I couldn't, the 100, 200 units was way out of reach. So
Right.
it really pushed me back down into this space. And so the first deal was 28 units, the second deal was 22 units, the third deal was 24 units, all in that range with that same business model. So that's why I did that. Because it really fit my life better than anything else, right? I could do it. I could get up early and do pay my bills for the apartments before work and things like that. That was easy, but I could actually make it fit. And I didn't have to spend weekends and nights over at the property turning units and doing stuff like that.
Yeah, a lot of people that get into this game realize that it's so much easier to manage multifamily units than single
It
family, because
is.
you can afford to hire, like full-time people once you get a large enough portfolio. And I think that's a great point, right? It seems that the new American dream is no longer to own a home. It's to have financial independence, financial
It
freedom,
is.
right? How do you make your nest egg or your business or whatever it is, create enough passive income where you don't have to directly be hands-on and involved 24/7? And I feel
Right.
like for especially a lot of busy business owners out there, they've kind of figured that out. Like, hey, I'm making good money. I'm not working 24/7. But I'd like to scale things down. But if I
Mm-hmm.
disappear from my business, then my income disappears. And they're looking for some of those alternative ways to invest, but not get caught having to take care of tenants or the phone calls at night to fix the toilet or the power going out, et cetera, et
Mm-hmm.
cetera. So real estate, you and I know, is a super powerful vehicle for this. And I think a lot of times where they get burned is they don't understand how to properly evaluate the deal. And they might do like 2 or 3 real estate deals, or their first one they get burned on because they don't know what questions to ask and they don't know what a good deal looks like. And
Right.
so what I hope to accomplish on this to with you today is to give the audience some insight and maybe some rules or some frameworks to use so that they don't get burned underwriting a deal and make a bad deal and lose money on it. So that being said, just high level, get into some of the deal analysis here. Where should somebody start?
Yeah. So if you're going to be the person like us that buys the deal, runs it, maybe raises money after you get a little experience to be able to go bigger, you do need to start with well, actually, you need to start with two things. The first thing you need to start with is this commitment to get into the details, to roll up your sleeves and not be afraid to figure out the numbers, right? So many people think that you can use averages and things like that for various expenses for a property. And I'm telling you, you can't do that. All right. I mean, I can put three properties together next to each other. One of them, if you do that, you make a killing. Another one next to it, you get destroyed. And the third one, maybe you'll do okay, right? Well, that's kind of like gambling. You don't want that. So the second thing that I want people to do is really dive into the numbers and learn how to underwrite. We've talked a little bit about, or before this call, about our investor education program. Remember, I've been at this for a long time now, and I didn't have anybody to teach me these details back in the beginning. They just didn't exist.
Yeah.
And so now, fast forward 25, 26 years, I've been doing this for a while. I feel comfortable. It's time for me to give back. And so now my passion is helping to teach people exactly how to do the underwriting so that you know when you're done, yeah, this deal makes sense. And I know the whole process. I understand where it's going and I understand why. So we actually have a 5-step process that we basically follow. And so we start off with, well, before the process even starts, you got to like the market and everything else, right? That's outside the underwriting or realm, but it's really important that you like the market, like the neighborhood, and like the property. You just, if you're missing one of those things, move on. Okay.
Yeah.
So step one then is you got to take the seller's numbers and you got to get them into some format that makes sense to you. Because if you've underwritten a few deals, the seller's numbers sometimes, I mean, they don't even make sense.
No, they never inflate the rents or anything on the pro
Yeah.
forma sheet they're trying to sell you.
They never accidentally leave off an expense that, they expense the month after they gave you the statements, right? So you got to spread, I call it spreading the seller's numbers. That's the first thing. Then the next thing that you have to do is, and this is, if your listeners hear one thing out of this call, it's this, right? It is, you have to understand the upside. You have to really understand the upside, right? It's not, don't run a CoStar report and say, okay, I know the rents. No. That's not how it works. CoStar reports, Yardi reports, all those reports are a month behind. That's not helpful. That's not. You need to know where rents are today, and then you need to look and see where are rents going. Because after you do your value add plan, you're going to put that property in a different competitive market, right? Mm-hmm. So you need to understand what it's going to look like when you're done, right? We teach you how to do that, but that's the next phase. Then you're going to take that information.
Real quick, I want to stop right there. What does that look like? Understanding the upside. So I think the classic thing, like what I would do, my brain, if it was a single family anyway, is I'm pulling comps. Okay, cool. This house right here on Zillow is renting for this. It's about the same square footage. Okay, it's got similar amenities, and I'm kind of building an idea and putting that in a chart, and I'm running rent per square foot numbers. And then I can take 3 or 4 that are in the same area, around the same size, around the same amenities, and kind of average out their square footage to produce something that tells me that, hey, this is the potential upside here. What other additional legwork needs to be done on multifamily to really understand the upside? Because I think you're right. This is a huge part about investing in multifamily, which is the value add side of it. And if you're going to invest in this stuff, you have to be able to know if there is upside on a deal and not just trust somebody.
Yeah. So I want you to get into the weeds, right? I want you to get in your car and I want you to go visit the property you're looking at. And I want you to find every property nearby and I want you to visit them. And I want you to understand, what are their 1 bedrooms compared to yours? What are their 2 bedrooms? What are their 3 bedrooms compared to yours? Now, here's where you got to get a little granular. Now, it can get overwhelming with the other fees and utilities, but there are a few things that really matter, right? Like utilities. How are they passed through? Are they not passed through? And we show you exactly which one of these things you need to pay attention to. And then what you're doing now is you're trying to get in the mind of a prospective renter. That's what we're trying to accomplish. So you've got to say, okay, if a prospective renter is looking at my property and several others in the immediate area, are they going to feel that my prices are where they should be? Are they going to feel like, man, dude, you're overpriced. I'm not living there. I can get so much more for so much less. You see, you want to understand that. That's how people shop for anything. It's not just rents.
Yeah.
It's how people shop for everything, unless money doesn't matter to you, right? And then you want to do that same analysis in the next tier up. That's what I tell people. If you're going to improve that property, you're no longer competing with those same properties, are you? You're competing with a better property now, because now you have a different prospect looking at your property, and they have to look at your properties that are similar to yours, right? With the pool and an outdoor kitchen or whatever it is that you have compared to the other properties, and say, yeah, you know what? I would pay this for this particular unit because it makes sense, right? You assume that the renter is going to be educated, and most are. I mean, most people don't waste money on rent. They're, they know if you're out of line, and they won't rent from you if you're out of line most of the time, unless there's some value that they deem associated with your property that maybe others might not see. But that's how you do it. You got to get really granular there, because here's the thing: you use the single family home or whatever as an example, but the reality of it is, single families, you're not everybody buys a single family for income purposes. Right. So now you're sort of looking at sales comps and everything else to try to determine what can you sell that thing for when you're done. You want your cash flow to be positive, but you also want to make money when you sell. In our world, this is the part that I love about multifamily that I can't recreate in single family homes. And that is multifamily properties are valued based on their ability to generate cash flow. That's generally the way they're valued. It doesn't matter what the guy next door sold for. Now, they might take it into consideration, but if I generate a lot more income than the guy next door, my property is probably going to be worth more.
Right.
So it stands to reason. I like that predictability. So now I can build a business plan around some level of predictability, that if I can move rents $100, and I've just proven that I can do it based on my assessment of the market, guess what? Now I can predict what I think that sales price might be when we go to sell it. Because the reality of it is, in the multifamily world, you get cash flow, and that's important. But the real payday is when you sell that property or refinance it and get all your money out. That's the real payday. That's why you're really in that business. So it stands to reason that you need to understand how far you can take rents so that you can figure out how much new cash flow you can create. Then you back into, well, okay, if I can only get $100, how much more do I want to spend on that property to get that $100? How much can I afford to? You see, that rent, that new income, which mostly drops all the way to the bottom line, is going to really help you figure out how much you're going to spend on improvements. Maybe you shouldn't spend any, right? Who knows? It's going to depend on the analysis, and that's what we teach you. But that's why in the multifamily world, this new cash flow, this rent thing is so critical. Because if I raise your rent $100, did I incur any new expenses? Probably not. Probably not, right? Probably not. So that means $100 just dropped all the way to the bottom line each month. And if you have 100 units, think about that: $100 a month increase on 100 units. What? That's 10 grand of new monthly cash flow times 12. That's 120 grand. You cap that out at a 5 cap. I'm doing the math easy here. That means I just created $2.4 million of income. I mean, that's obscene money. That's just crazy money. Wouldn't you agree?
I love how you went into the detail there on like how to calculate the upside. And yeah, to your point, you're valued based on a business, right? It's how much money does this thing prove? So you said step one was, without going into the numbers, just the area, the asset class, understanding where you want to be and what you want to be. And then you said step two, understand the upside. And then I cut you off there. So what's step three and beyond?
Yeah, so it's just make sure you're cool with the market, neighborhood, and just generally the character of the property, the non-numerical piece of real estate.
Yeah.
Then step one said spread the seller's numbers. Step two, understand the upside. Step three, now you're going to use that information to project income. And of course, you have to project the expenses. And how do you figure out what expenses are? You know what I tell people? Man, I've never owned a property before. How do I know how much pest control is? You want to know how? You pick up your phone and you call the pest control company and you say, hey, dude, I'm about to buy this 100-unit building. How much should I budget for that? And then you call a second one or a third one. Now, I think people might say, dude, you're nuts. There's no way I'm going to spend that time. But look, I'll tell you, you only have to really do that once, because then right? And if you're ever going to go out and raise money from outside people, they would hope that you would take the time to do the real research. So you're not just guessing at any of those numbers, because they're investing with you based on those numbers. So you're going to project income, project expenses, then project improvements. And then you're going to go away for a minute. You're going to close your computer. You're going to go have a drink, do whatever it is you do to relax. Then you're going to come back and you're going to look at these numbers with a clear eye and say, okay, is this thing still make sense? Right. That's what I want you to do, because so many times you can get buried in the numbers, and two things will happen. One, you can get yourself in this circle that never stops, right, which is maddening. Or you can start changing little numbers here and there, and if I do this and I do that, all of a sudden, ooh, the deal looks good. You can actually create. I call it you're penciling your way into a bad deal, right? I don't want to do that.
You're trying to force it
all the time. Yeah, people do that all the time. So that's our process. Now, initially, it's more painful than as you've done this a few times. And I mean, it's amazing how much, when you take the time to roll up your sleeves and get into the details, you understand. You legitimately understand what, you understand how, you understand why. And now the next deal comes along, you have this basis to make a new decision about a number on that property. And when an investor asks you a question about something and your projections, guess what? You know why. And that investor is going to say, wow, this guy really knows his stuff. It's going to just increase their confidence in you and your ability to execute.
One of the problems that I've experienced underwriting multifamily, and this is why I hire people to do this, because I try to stay within my unique ability. And I know that a lot of my bad investments have come, quite frankly, from me not understanding things, me investing in things that I don't know or understand or have like an edge in. And I love multifamily. The underwriting, I'm not like super sophisticated in it, but I bring in partners that understand that part of it. To somebody who's just starting their journey to start investing in multifamily, or at least starting to understand the underwriting, because maybe they just want to be like a limited partner and invest in it first before they figure it out, before becoming like a general partner in it. What does the process look like to learn this stuff?
Yeah, I mean, most people, they take a number of paths. They do. A lot of people will just go to, masterminds and things like that. I believe that let's differentiate between a limited investor and somebody who's going to actually operate the property. If somebody's going to operate the property and I'm going to call you and say, hey man, I want you to put some money in my deal, I need to have rolled up my sleeves and I need to understand the business. That's the starting point. You start off with a program like ours or any others that are out there that really gets into the nitty-gritty detail, because you only need to be in that detail one time to understand, because then everything else plays off of that. So that's where you need to start. You just need to start there, because it's not that hard, right? Our program, we give you the whole spreadsheet. You just have to not screw it up is what you really have to do. Yeah. Right. And so it's not that hard. If you don't start there, let me tell you what happens if you don't start there. People try to start in this business at 30,000 feet, and they're constantly asking themselves, I don't know why. I don't know how much to pay. I don't understand. And they know that they don't know what's going on underneath those high level numbers, right? If they say, oh, contract services between $200 to $400 a month per unit, or $200 to $400 per unit. Well, what does that mean? Like, why is it that? I don't know. That's what I saw. But the course I took told me $200 to $400. Well, first of all, that's a big range. And second of all, what's included in contract services? And what do you choose? 200, 300, 400? What should you choose? See, you have no clue why. So what happens is then so people, they make bad decisions because they don't understand why. They don't even know when a number isn't right because they haven't taken the time to understand why. So either the risk averse people will stop, and so they'll say to themselves, I don't understand this. I'm not going to do this. It's too risky. And I know enough that I don't understand, and therefore I'm not going to go forward, right? The alternative people will trust the system, right? And say, oh, well, the banks won't let me get myself in trouble. And well, they will. Okay. They always have, and they always will. Nobody's there to protect you. So That's what usually happens with those people who try to fly at 30,000 feet. And I feel bad for them, because you made a statement earlier. If you don't do really well in your first deal, you ain't coming back. And that's not wrong. You will not come back, especially if you invite your friends and your family into the deal with you.
Mm-hmm.
Right? That makes for a terrible Thanksgiving dinner, to be sitting across the table from some family member that invested in your deal, but you screwed it up because you didn't pay attention to the details.
Yeah.
So,
No. Yeah. Especially given the amount of capital needed for, multifamily investing, and you can start small, right? Fourplex if you want to build up, and
yeah,
10plex and 20plex and 50plex. But, when you're getting into, 50 plus units, you're talking about millions of dollars
yeah.
involved of other people's money. And it's a serious thing. I want to get your take, before we wrap this up, on the current environment. Interest rates have had a historic rise. It's been a black swan event. Everyone's talking about this wave of commercial that is going to be, facing foreclosure. There's already people out there producing articles talking about how the government needs to have some like debt restructuring program set up, and some kind of program set up for this wave of commercial that's coming due or has to be refinanced. Given that, how are you navigating the current environment in interest rates? Are you starting to see a lot of distress? And how are you approaching deals now with this very volatile market?
Yeah, there's a lot packed into that question. So, first of all, how are we dealing with interest rates where they are now with the properties that we own and operate? So remember, I told you we're about value add. We're about moving income. That's really, really important. Well, one of the side benefits of having a lot of new income in your deal, right? Like if you raise, let's say you get 250 units and you raise rents $250. I mean, that's an insane amount of new money. Well, guess what that new money does? It helps protect you against more interest expense. It helps protect you against higher insurance, right? i.e. Florida. It helps protect you against inflation, all of the above. That's why we need the upside, right? So that's how we're dealing with it. Now, when we're underwriting deals to buy, look, the reality of it is sellers want us to still pay a 4 cap, but our debt is at 6.5. We can't pay a 4 cap, right? So I always tell people cap rates are not that hard to figure out. Cap rate is basically you have to have enough income in your deal to pay the lender and have some left over for your equity people, right? That's it. Well, if you pay a 4 cap, that means the lender wants 6.5. There's almost nothing left for your equity guys, right? You can't do that. That's not, unless you have equity people who just don't care about money, which nobody has those people, right? You need to get what's called even leverage, as close to even leverage as you can. That means that you can pay the loan, you have some left over for your equity guys, and that means a lower selling price than it did 2 years ago. And sellers that don't have to sell right now are not. They're like, why would I want to take a bath on my property? I don't need to, right? I don't need to. But the people that are selling are the ones that for some reason have to. Either they have a partnership problem, their bridge loan, their variable rate debt is coming due, and they no longer have enough cash flow to service the debt because the interest rate on the bridge loan went from a protected 4% with a rate cap to now 9%. I mean, that's crazy increase in interest expense. So those are the people that are selling now. But as buyers, I mean, you can't go out and pay a 4 or even a 5 cap on this stuff because rates are at 6.5, maybe even more in some cases. So sellers just have to come down and be realistic about their values. And the only ones that are doing that are the ones that really, they're almost selling with a gun to their head because their lender's like, look, man, you don't have enough cash flow to pay me out. Well, you got to do something so you don't lose your building.
Yeah.
So that is happening.
I mean, with your current portfolio, have your rents really increased enough to cover the increase in the mortgage? Because, correct me if I'm wrong here. I mean, the mortgage is usually around 40, 50% of the, I mean, it's usually like 40, 50% of like what your expenses are, right? Associated with that property. So if you're usually at, 40, 50% of your cost to hold that asset, and that cost doubles, I mean, it's really tough to get your rents to, go up 50+%, a lot of value add guys are like, 15, 20% is pretty good. I've seen 30%. I've seen some 50% ones, but to really knock it out of the park and increase rents like more than 50% to accommodate this interest rate increase. I mean, there's not very many properties that can do that, but maybe over a 4 or 5 year period as they hold it, right? Or, 10 years or something like that.
Yeah, you just said the magic thing there. And that is, in the real estate world, if something moves against you, usually your defense is to just make sure you don't lose the property, and time will bail you out, right? Time, rents, inflation will continue to eventually bail you out of that. That's typically the most obvious defense. Now, you asked me a question when you first started that, and that was, did I really get that much new rent? Well, I'll give you an actual deal. We have an 84 unit deal that I think we've gotten $36,000 of new revenue per month since we bought it. So we bought it October of 21, and till now we've moved rents, and we actually started building back some utilities, but we moved income 36,000 a month times 12. That's $432,000. Let's use a more realistic 6 cap because I got my handy calculator here. That's $7.2 million of new value I created at a 6 cap, right? Now, let's divide that by 0.06 again. I'm sorry. What did I say? 432,000. I have $432,000 that is available to me to pay higher insurance, to pay higher interest, whatever it is I need to. Now, in that particular deal, we bought it with the intent of repositioning it. We put a 3-year bridge loan with a rate cap in place. But less than 12 months in, we knew that we were going to move rents fast. How did we know? Because we really understood the upside. And we moved rents within 12 months. I was able to put real Fannie debt on it, and we did it at 528. Why was I able to do that? Because I moved rents an enormous amount in a very short period of time because I understood what I was going to do. And then I was able to lock in 7-year debt at 528 because I was really mindful. I don't like downside interest rate risk. When you say downside, I mean negative risk, right? I don't like that interest rate risk. So I want to get it off the table as fast as I can. And so we knew we would speed through this process. Nobody knew we were going to move rates that much, but you can see we were able to lock in 7-year money at 528. Well, there's a lot of people that would kill for that right now. Yeah. That deal is locked up, put to bed at 528. We are good. We are good for a long time. And we did that in our Daytona deal. We did that. Well, Daytona already had fixed rate debt on it. Our Bradenton deal, fixed rate debt on it. We have a winter deal in Winter Haven that we've moved rent so much. We've had that building for a while. We've just refinanced it at 572 or something like that. And so the point is that, see, people don't necessarily think about why experience matters in any business, but 25, 26 years, guess what that means? I went through 08, 09, and I saw what happened to credit markets when things don't go well. And so that makes me hyper focus on managing some of the risks that a straight real estate person might not focus on, right? But I knew, because I had that long track record, that long experience, I'm like, man, I am not playing with this. This can sink you if you're not careful. And so we were able to put Fannie debt on it, on that Tallahassee deal. That was actually lower than our rate protected rate cap. So yes, we actually do create enough new income, but it comes with, it just comes with real careful, making sure you understand the market that you're in and what your business plan is. And then you talked a little bit about being an operator. You've got to execute your business plan. That's the other thing that has gotten people in trouble, is if they're kind of new, right? They don't really know how to execute this business plan yet, or they relied on a third-party manager. Just got to be careful. Nothing wrong with third-party management, but you got to make sure they execute the business plan and do it really quickly, like we've done. And that's part of when I see people failing now, it's because they didn't execute, either because they didn't understand the upside or the execution itself wasn't good. This is a business, man. This is a business. That's what I keep telling people. Just because it's multifamily doesn't mean it's not a business. It is. I guarantee you it is. It's not a single family home. That's probably not a business. But 100 unit, 200 unit property, that's a business. And you got to understand everything about it.
Kenneth, this has been an absolute pleasure. Thank you for sharing all your knowledge on this whole subject. If people want to learn more about you, learn more about your courses, where do they go?
Yeah, go to kripartners.com. That's the best way. Reach out to me if they want directly, kgee at kripartners.com. So kripartners.com, and make sure to reach out to me because I'd love to have the conversation with them and see what they're trying to accomplish.
Yep. We'll put that in the show notes. It was great having you on. We'll see you next time.
You bet. Thanks, sir.